Today we are going to start our chapter number 7 of the Kaplan study text, in which we will discuss governance general principles. What is the corporate governance, or what does it mean? What is the difference between ownership and control? What governance covers? What are the key concepts, purposes and scope of the governance? Agency theory, key concepts of the agency theory, stakeholders theory, and stakeholders claims. So all of these things are covered by general principles of the governance. First of all, overview of corporate governance. What is this corporate governance? What does corporate governance wants to communicate to their shareholders or stakeholders or other um, relevant stakeholders in an organization. So in this chapter, we will discuss what is the purpose of the corporate governance, what is the definition of corporate governance, and what are the objectives. Simply, I would say that wherever we use the word of governance, it means someone is playing the role of a watchdog, or someone is trying to make sure that there is a control environment within the organization, and the whole organization or a few responsible people within the organization are trying to protect the interest of most of the stakeholders. So this is the story or basic purpose of the corporate governance. What does corporate governance wants to do? Corporate governance wants to develop a control environment. Then we will discuss agency theory. Agency theory is basically what? Agency theory is basically relationship between the principal and the agent. Principal means owner and agent means management of the company. So we will learn the relationship between owner and the management of the company. What are the objectives of the owner and what is they are expect from the management to perform. This is called agency theory, or we also call it a principal agent relationship. Principal agent relationship is what? The principal agent relationship is the relationship between stakeholders, especially shareholders, and the management of the company. So this is what we will discuss in the further of this chapter, and we will also discuss the stakeholders. In fact, a responsibility of an organization is not to protect the interest of shareholders only. They are expected to protect the interest of all the stakeholders in the organization. Now, stakeholders include what? Stakeholders include employees, stakeholders include directors, stakeholders include managers, stakeholders includes customers. Stakeholders are our suppliers. One of the very stakeholder is our government. Stakeholders are the finance providers like bank. Stakeholder is the community at large. Stakeholder could be environmental pressure groups who expects corporate social responsibility from the company, and for sure stakeholders are shareholders, owner of the company. So each one of the stakeholders has its own objectives towards the company. They expect from the company that company will fulfill their objectives. So this is what which we are going to discuss in the further area of this chapter, corporate governance. Now, first of all, we will discuss company ownership and control. Who is the owner of the company? We all know that shareholders of the company are the owners of the company. Usually, shareholders are public, or shareholders is public. Public does not mean the whole population of the country. Public means the people who own shares from the public for a particular company. They are called what? They are called shareholders. What does they expect from the company? They expect from the company to maximize their wealth. Main objective or prime objective of the shareholders from the directors and from the management is to maximize their wealth. Corporate governance is the system by which companies are directed and controlled in the interest of shareholders and other stakeholders. But mainly, first of all, they will protect the interest of what? Mainly, they will protect the interest of shareholders. Their objective is to maximize the wealth of shareholders. Now, who are the directors? Directors are the one who could be treated as or who are the key players of the organization. Basically, they are the one who are making strategic plans for the organization. They are trying to achieve what? They are trying to achieve long-term plans for the organization. They are trying to achieve mission and vision for the organization. So they want to do, they expect from the management to maximize their wealth, or they expect from, sorry, they try to fulfill the expectations of the shareholder, and they make long-term plans which will ultimately maximize the shareholders' wealth. So they always try to protect the shareholders' interest first, but not only the interest of the shareholders. They also try to protect the interest of all the stakeholders. Basically, directors are responsible towards the all stakeholders of the company, and they try to and they always try to protect the interest of the all stakeholders. Ownership and control. So shareholders are the owner of the company, but they are not managing the organization. Basically, shareholders do not have the control of managing the organization. They are not making long-term decisions, although they vote at the end of the accounting period in the annual general meeting, or if there will be any specific decision and management wants their vote without voting of the management, without voting of the shareholders, management is not willing to invest in any project. So that's why shareholders' roles become important in the decision making. Otherwise, they are not involved in day-to-day operations. They are not involved in quarterly planning. They are not involved in quarterly objectives achievements or profit achievements or annual targets. They only want or expect from the management of the company to maximize their wealth. And maximization of wealth, what they expect from the management in two forms. First one is capital gains. They want capital gains, or they expect from the management that management will increase the will try to increase the share price. Now, how management can increase the share price? Management can increase share price by using management can increase share price by achieving profit targets. So the other purpose of the management is dividend. Management wants to maximize the dividend, or shareholders expects from the management to pay them higher dividend from profit after tax. Uh, my voice is loud, but I will suggest you to check your volume on your laptop. Now it is clear. Okay. So this is what this is company honors and control. Ownership means what? Ownership means shareholders, they have their own objectives. Now, what is this control? Control means management. Who is managing the control? Directors are managing the control. Managers are running the company. So mainly directors and managers are involved in decision-making process. Directors are making long-term plans and managers are making short-term plans. They are the one who are making plans, and they are the one who expects from the directors and management that they will achieve their targets or plan. But both of them have their own objectives. It is not necessary that management is only trying to achieve, or management is only focusing on the wealth maximization of the shareholder. In fact, management is also trying to maximize their promotion, their bonuses, or their own objectives. So management would also put their objectives first, but not before the shareholders. They would try to achieve targeted profit. They would try to achieve targeted share price. They will try to pay good dividend to the shareholder, and after that they will ask for their promotions or their financial objectives once they have achieved their targets or goals, which was set by the senior management or board of directors at the start of the accounting year, or which is set by CEO of the company or chairman of the company. So this is the clear difference between ownership and control. Definitely, this difference of ownership and control only exists in public companies. Public limited companies or public limited listed companies where there are thousands of shareholders in a company, and the stock share price is listed in the stock market. Anyone can purchase shares of the company from the stock market, and whenever existing shareholders want to sell their shares, they can sell their shares from the market. So this is a factor, or this is the one which is very important over here. So ownership and control is an important thing which we needs to understand. And we know that they are trying to do what they are trying to protect the interest of all the stakeholders, not only the shareholders. Although shareholders are their priority, or shareholders are their primary stakeholders, but apart from shareholders, they will try to protect the interest of customers, suppliers, environmental pressure groups, government, bank, and other finance providers. There, any question related to ownership and control? Okay. Next one is coverage of governance. What does governance cover? Governance focuses on internal to the organization, and as well as focus of the governance is external to the organization or external to the company. Internal to the company means what? Strategic direction from board of directors. Basically, a board of directors will provide long-term direction or long-term objective or long-term goals which a company wants to ultimately achieve. Or we can say that strategic direction focuses on what? Strategic direction focuses on vision of the organization, or it focuses on mission of the organization. Basically, they are the ones they are who are trying to communicate their workforce what ultimately they want to achieve. If they are running a profit-seeking organization, then definitely they will say, or they will set their target of profit maximization. They would say that we want to become the best company in the market. Or if they are a not for profit seeking organization, if they are a charity company, then definitely they will try to maximize the welfare of the society or welfare of the segment for which they are operating their NGO or not-for-profit seeking organization. So this is called internal to the company. Whenever we talk about internal means first of all, governance is relevant with the strategic direction or directors or with the long-term goals or objectives of the organization. Second very important thing is risk assessment and response. Basically, we want to learn that how different risks can affect our business. On as a whole, we have one risk which is called business risk. Each one of the business has its own risk. Suppose if you are managing a restaurant, it is not necessary that once you visit a restaurant, you were there were suppose 8 to 10 guests with you. Soon you will visit again that restaurant with the same number of guests. Maybe possible you will not visit in next 12 months in the same restaurant. So this is the business risk. Similarly, in most of the businesses, it is not necessary that our customer will repeat, or it is not necessary that we will have the same customer. This is a business risk. In technology businesses, we always face a risk of obsolescence. All of the technology companies, either they are selling mobile phones, either they are selling laptops, or they are selling any kind of laptops or computers. They know that their or any other gadget, they know that their technological product has a certain useful life, and after that they need to launch the new model in the market. If they will not introduce the new model in the market, then definitely their business risk can rise or business risk will arise. So business risk is the one which varies with business to business. Here we will learn business risk assessment and response. Response means how to react to the risk. It is not necessary that you will always be able to respond to all the risks. You will always be able to manage all the risks. Maybe possible you will accept a few risks because it will not affect you significantly. On the other hand, there could be a few risks which you will like to avoid because it can lead you to a bankruptcy or it can lead you to liquidation. So you don't want to take such type of high risk. Similarly, suppose there are a few risks which you want to transfer. You want to purchase insurance contract and you want to transfer the risk of fire. You want to transfer the risk of accident. So this is another type of risk which can be transferred to the third party. So these are the responses of the risk. And at the end, we will like to avoid a few risks which are seriously problem for the business and which can affect our business. But we are in a position to avoid those risks. Otherwise, it is not necessary that you want to avoid a risk and you will be able to avoid the risk as per your preference. Okay, clear? Any question related to strategic correction and risk assessment and response? Okay. Next one is control of operations, internal control system. Internal control system is basically the key area of corporate governance or control environment. If internal control system will be strong or internal controls will be strong, definitely you will be able to maximize your profitability. You will be able to maximize transparency within the organization. You will be able to increase the value of your financial reporting in front of users of the financial statements, and your financial statements will be highly reliable in front of the external auditors. So control of operations or internal control systems is the one which plays a very important role or which is the key area in this corporate governance or in this internal control environment. So internal control environment, as I told you at the start of the lecture, that main purpose of the governance is control environment. And mainly it is internal control environment where transparency and accountability is the main objective of the organization. Where all the directors and managers think that they are accountable, held accountable, or it is their responsibility to present transparent financial statements to the users of the financial statements like shareholders, government, banks, other prospective investors. So all those who wants to see the financial statements of the company, like financial analysts who wants to know that either to purchase the shares of this company or either to sell the share of this company, it is the responsibility of the management to provide them a true and fair view of the financial statement, which is only possible if internal control systems are high or if control environment is high. Then we have regulatory external to the company. External to the company, first of all, deal with regulatory framework. Regulatory framework means laws and regulations introduced by the government for a specific industry. And the other one is code of practice. Now you need to understand what is the difference between legislation and what is the code of practice. Legislation is basically a binding contract, a law. You have to follow the legislation. It is a binding contract. If you will not follow legislation, you will be punished and you have to face penalty, or it is also possible that someone has to face imprisonment if he or she is not following the legislation. But code of practice is not a legislation. Code of practice is basically a code, something which expects from the users or which expects from the management that they will follow some ethical ethics or ethical rules when they are performing different activities, or it expects from the individuals or us as an accountant, as professional accountants, that when we are involved in our day-to-day professional practices, we will behave like ethical individuals or we will work like ethical professionals in the market. Although it is not our binding contract, but we assume that it is a built-in binding contract, or we can say that it is an insight or expectations of from a professional that a professional will perform in an ethical way or in a responsible way. Then he says that wider social and ethical responsibilities of the company. So wider ethical and social responsibilities of the company means you will work as a corporate citizen. Basically, this concept is called CSR, corporate social responsibility, or use another word which is called corporate citizen. What is the meaning of corporate citizen? Corporate citizen means when you are doing a business in a market, we expect from you as shareholders, as environmental pressure groups, as customers, and other stakeholders of the company, like as a community, like as government, that you will contribute some amount towards the welfare of the society. You will contribute towards the sustainability of greenery. You will contribute towards the sustainability of the environment, or you will contribute towards the education if you are managing a company in a less privileged country, or you will contribute towards the medicine. Similarly, if you are working in a less privileged country where people are facing problems with the basic facilities of the life. So this is called corporate citizenship or corporate social responsibility. So we as a corporate expect from so we as a stakeholder expect from corporations that they will contribute a certain profit percentage towards the society from where they earn revenue and from where they earn profit. Suppose it could be like 2% of the profit after tax, or it could be like 5% of the profit after tax. It depends on the company's management. It is called code. When you are expected to decide on your own, it is called code. But on the other hand, if law says that you have to contribute 5% of the profit after tax towards the environment of the country, now it is a legislation and now it is a binding contract. Now companies would have to contribute 5% towards the environment, otherwise they will face legal consequences or complexities. So to avoid legal consequences or complexities, they will definitely follow the instructions given by laws and regulations. Right? Any question? Now we are heading towards the key concept of the corporate governance. This is what which is very important and needs to memorize and understand. First is it starts from transparency. What is this transparency? Transparency means open and honest relationship with the shareholders or clear decision making. Basically, transparency means company is not going to do any window dressing with their financial statements. Company is not trying to manipulate the profitability of the organization. There is no manipulation. Or company is not trying to change the accounting policies which can increase their account profitability until or unless it is suggested by the standard or it is the need of the management or need of the company to change the accounting policy. Purpose of the change in accounting policy is not the manipulation. This is something which is very important. This is called transparency. Whatever we are communicating to our shareholders right now about our financial position, this is given true and fair view. Our objective is to provide true and fair view of the financial statements. We don't want to cheat our shareholders and other stakeholders and especially prospective shareholders of the company. We want to provide them correct profitability and correct statement of financial position on the basis of that correct financial position and profitability. They will be able to decide either to hold share for the company or to sell share of the company, or prospective investors can decide either to buy the share of this company or not. So this is what which is very important to learn and understand, that main objective of the organization or main objective of corporate governance is to do what? Main objective of corporate governance is to maximize the transparency of the financial statement. And transparency of the financial statements depends on what? Transparency of the financial statements depend on strong internal control system. Where there will be strong internal control system, or there will be strong internal control environment or a strong internal controls, definitely management will be able to respond to their shareholders with a transparent financial statement. There will be no flaws in the financial statements. There will be no fraud, or there will be no window dressing. So this is the meaning of the transparency of open and honest relationship with the shareholders. Here, transparency focuses on the shareholders, especially the one who owns shares right now and the other one who wants to purchase the shares. Right? Any question? Okay. Then we have probity or honesty. What is the probity or honesty? Culture of honesty. Basically, management wants to develop a culture within the organization, either through training, either by giving good financial packages to the workforce, either by strengthening the internal control systems and environment, or either by using all the variables which can bring the culture of honesty. Suppose by hiring quality employees from the market, those who have good reputation in the market, or they are ethical in their day-to-day performances or practices, and clear sense of ethical stance. Clear sense of ethical stance means people are very much clear about their responsibility, or they are responsible in their behavior. Basically, they are not showing any kind of casual attitude or irresponsible attitude towards their job. They are presenting responsible behavior towards the organization. towards the customers, towards the suppliers, or towards the other stakeholders of the organization who are directly or indirectly getting any kind of benefit to the from the organization, or can provide any kind of benefit to the organization. So culture of honesty and clear sense of ethical stance is quite necessary, which is another aspect of the corporate governance. Third one is independence. What does it mean, independence? Independence means we want to uh, introduce a balanced board of directors within the organization, or non-executive directors should be greater than the executive director. If it is not possible, then board should be balanced and executive directors must be equal to the non-executive directors. Non-executive directors are basically not employees of the company. When they are not employees of the company, they are not getting any fixed salary from the organization. So we can expect that they will perform their job quite effectively or efficiently. Basically, what they are protecting the interest of different stakeholders, especially they are protecting the interest of shareholders. Non-executive directors wants to make sure that the financial statements which are provided by the company are transparent. They wants to make sure that this characteristic transparency exists in the financial statements. Management provided honest information about the statement of financial position and about the profit and loss to the shareholders of the company. There must not be any conflict of interest. Now, what does it mean, conflict of interest? Conflict of interest means, suppose I am managing any business, and I am also working as a director of the organization. Suppose I am managing a business which sells laptops in the market, and I am also working as an employee of the company, and I am working as a director in any company. My company in which I am working as a director wants to purchase wants to purchase laptops, and my business is providing quotation to my company, and because I know that what is the quotation or what is the price offered by the other competitors in the market, so it is quite easy for me to reduce the prices of my laptops and I can get this order. Or I can introduce my friends, or I can introduce my family members. They can offer their prices for those laptops, and I am the one who can provide them insider knowledge. So no conflict of interest is very important. That whenever we are doing or whenever we are performing a job as a director or manager, as in the organization or as a senior management in the organization, our main objective is what? Our main objective is to protect the interest of the shareholders and to protect the interest of the organization rather than to protect our own interest. If I am trying to protect my own interest, it creates conflict of interest. It creates an environment where people will face a problem, where there could be financial indiscipline within the organization. And in the short period of time, my actual financial position will be exposed to the shareholders. So where there will be no conflict, it means and management is independent, especially non-executive directors are independent. When non-executive directors are independent, it means now we can expect that financial statements are transparent and financial statements are providing us true and fair view. One more thing which you need to understand, what does it mean true and fair view? True and fair view does not mean that 100% correct financial statements. It does not mean, although by using computer software, now it is possible to check the 100% population of transactions or 100% transactions within the organization. And if it is possible to check all the transactions within the organization and none of the transaction contains material misstatement or material fraud, now we can say that we are providing a 100% true and fair view. But still, true and fair view means what? True and fair view means your financial statements are free from material misstatement and material misstatement and error, or material misstatement and fraud. Basically, as a whole, there is no problem with the financial statements which we evaluated as external auditor. And non-executive directors are the one who will also connect with the external auditors. They will remain in contact, especially at the start of the audit, during the audit, and at the end of the audit. And they will make sure that internal management or directors of the organization are cooperating with the external auditor. They are not trying to influence the external auditor. So this is what which is very much necessary to watch and to observe, that independency is not only maintained by the non-executive directors, but independency is also maintained by the external auditor. And no one is trying to influence the external auditor, or no one is trying to give any kind of threat to the external auditor. So this is called independence, right? Any question? Fourth key concept is reputation. What is this reputation? Reputation means development personal relationship and moral stance. Definitely, when you are providing transparent information to the shareholders, when you are following code of ethics and regulations in your business, when your non-executive directors and workers are working, sorry, non-executive directors and external auditor is working independently, even non-executive directors are also involved with internal auditors, and internal auditor is also working independently within the organization. Although internal auditor is the employee of the company, but still, due with the help of non-executive directors, internal auditor is able to maintain its independency. When you are following transparency, honesty, and independency, definitely it will increase the reliability of the financial statements, and financial statements will be free from material misstatement and error. When financial statements are free from material misstatements and error, it will enhance the reputation of the company in front of shareholders and other stakeholders of the organization. And reliability of the shareholders and other stakeholders will rise. So this is what which is called reputation, or it is the one which is the relevant factor. Anything else? Any questions? Especially one more thing, which is called code of ethics, code of practice. Code of practice, as I told you, that code of practice is not a law. Code of practice is not a binding for an organization to follow. Code of practice is something which expects from the management that they will perform in an ethical way. So if you are following code of practice, it will definitely improve your reputation, or it will improve your reputation towards ethical stances, that you are working in an ethical way. Next one is fairness. What is this fairness? Fairness means even and ethical dealing with all the stakeholders. Now, fairness, difference between, what is the difference between equality and the fairness? This is what we need to understand. Equality, suppose I say that I have $100 to distribute, and there are 4 participants. So I divide each $100 equally among 4 participants, and I am paying $25 to each. This is called equality. It is not fairness. But suppose one of them is already having 20, one is having 30, one is having 50, 40, and one is having 50. Now I need to distribute 100 in a way that it will equate the amount of everyone, and everyone they will be able to have the same amount. This is called fairness. Equality means you are trying to equalize all the stakeholders in the company, which is not possible because all the stakeholders in the company or all the stakeholders of the company do not have the similar stake. Shareholders of the company have invested in the company, so they are the owner of the organization and their stake is quite high. Their stake is financial stake. They want to maximize their wealth. They expect from the management that management will fulfill their promise, which they made in the vision and mission statement that our objective is to maximize the shareholders' rights. So it is expected from them that they will maximize the shareholders' rights. People have ethical duties all stakeholders made. Now, they will try to provide value for money to their customers. They will try to settle the liabilities of their suppliers timely, or they will try to fulfill the promises which they made with their suppliers. So their suppliers is another stakeholder, but promise with the stakeholder is different. They will try to satisfy the expectations of the community at large by not doing any physical activity. They will try to invest in environment and as well as they will satisfy the needs of the government, they will satisfy the needs of the employees. So they will try to meet the objective of each one of the stakeholders. This is called fairness. This is not called equality. There, any questions regarding fairness? Next one is integrity. What does it mean to be integrity? Strict, moral, and ethical. Integrity and honesty is somehow one and the same thing. Honesty means what there is a clear sense of ethical stand, and integrity means how you are strictly following the ethical code. Suppose ethical code is like confidentiality. You will not share the information of the employer or being an auditor. You will not share information of the client to someone. So integrity is something which is important here. Similarly, another factor of the ethical code is integrity, which needs to be followed. Whenever you are working as an auditor, either internal, external, or when you are working as a non-executive director, you can say that, I hope now my voice is clear. You can say that you should remain objective. Objectivity means what? You will not compromise your ultimate purpose of evaluation of the financial statements. You will ask for the audit evidences from the management, so there will be no compromise on the objectivity. Similarly, ethical code says that whenever you are performing any job, you should take care of professional competence and due care. Now, what is this professional competence and due care? Professional competence and due care means you will not say that you are able to do more than your qualification or more than your professional competency. Suppose you are the one who has capabilities of auditing. You are the one who can prepare financial statements, or you can provide auditing services, or you can provide taxation services. This is what which is your scope being a business management accountant or a ACCA, or either you can support in the forecasting, planning, budgeting. So these are your roles. You will not try to pretend like a competent engineer if you are working in an organization where there are number of machines and basically the technical core or main workforce of the organization is engineering. If you are working in an oil company, your expertise is not same like the oil engineer. Your expertise are different. Your expertise are limited to finance. So please do not present your expertise or competencies more than the level which you have. This is what which is expected from the management or professional competence and due care. Any question? Okay. Next one is innovation. What is this innovation? It is another aspect of the corporate governance. What does it say? It says that you need to innovate your reporting, innovation and experimentation in the reporting. Basically, a new concept which we will study in later chapter, integrated reporting. Integrated reporting says that now you are not required to only report the financial position of the company. You will report the other relevant areas in your financial statements or in your financial report. Suppose you will share the information regarding your corporate social responsibility. You will share the information regarding corporate governance. You will share the information regarding your prospective financial information. You will share information regarding the contribution towards the other areas of the society which are affected or which are relevant for the organization. So there are a number of things which needs to be present now or which needs to add in the financial statements or financial report apart from the uh, finan- financial position and profit and loss account. You will show a report which is covering the internal control system and how will you bring further improvement in your internal control system. So this is what which is called innovation. That now company will try to innovate their financial statements which will provide more transparency. What is the purpose of innovation and experimentation is the reporting means we want to provide more transparent financial statements to the shareholders or users of the financial statement. We want to provide the financial statements which are presenting our integrity towards the business or towards the organization. So this is what which is covered by the innovation. Businesses moved away from rigid compliance towards the better communication of its individual value creation story for its providers of the financial capital. Here he wants to say that nowadays businesses wants to contribute towards the society. Basically, businesses know that now it is very much important for an organization to add value in the society. As I told you earlier, either by managing any less privileged schools, either by managing less privileged hospitals, either by providing food to the less privileged individuals, either by providing some additional incomes or gains to the less privileged people. You want to add some value towards the society. You want to invest, suppose, in the green environment. You want to reduce the temperature of the country in which you are operating, or you want to contribute in each event, in each celebration, which is close to the culture or religion of the country in which you are operating or in which you are doing business. So basically, this is your objective. Now you don't want to limit yourself with the only with the compliance with the laws and regulations that you are only following laws and regulations and now and you are not going beyond laws and regulations. you will go beyond laws and regulations. You will add some value uh, by different. You will add some value to different ways, which are suitable for the business or which will enhance the reputation of the business. Another benefit of this approach is to attract the quality employees from the market and as well as quality finance providers, especially institutional investors or wealthy individuals who always wants to work with those organizations, those who has good reputation in the market. So it is very important for the organization, or it is very important from the uh, responsible organization that how they are valued by quality employees and quality finance providers, especially wealthy individuals and institutional investors. Because if they are valued high by them, they will be able to attract further finance, or they will be able to add more finance or growth towards the organization. Okay. Any question related to innovation? Okay, then we have accountability. What is this accountability? Basically, we want to introduce a culture within the organization that managers and directors, everyone in the organization feels that they are answerable to someone, to whom they are answerable to the shareholders of the organization. They are answerable to the stakeholders of the organization. There is someone who is observing their activities towards the organization. So provision of complete information to all stakeholders and effective risk management. So this is what which is expected from the management, that they will behave in a responsible way because they are accountable. Provision of complete information. As I told you, that transparency, honesty, integrity, true and fair view, uh, follow the ethical code, follow the legislation rules which are governed by the or which are provided by the government to all stakeholders in effective risk management. I told you that what is risk management? Risk management means how do you respond to the risk, different business risks which can affect your business. Either you have to accept the risk, either you have to reject the risk, either you will transfer the risk, or you will use any other technique which is relevant with the risk management. Now it depends what is the impact of the risk. Basically, you will evaluate the impact of the risk. If the risk of the impact is quite high, definitely you would like to reject the risk, or you would like to transfer the risk to any third party. As I told you that you can use the insurance contract which can help you to transfer your risk to any other party. So next one is responsibility. What is this responsibility? Responsibility is acceptance of the responsibility for governance decisions. Basically, management is ready to accept the responsibility of the corporate governance, and management understand this fact that they are responsible towards their stakeholders, they are responsible towards their shareholders, and it is their responsibility to follow the decisions which are related to corporate governance, which covers internal control systems and overall control environment. It is possible when there will be clarity or roles of roles and responsibilities. Basically, we will provide, or we will follow what we will follow segregation of duties. Basically, we want to segregate the duties, and we want to minimize the risk of theft and fraud. We want to minimize the risk of theft and fraud by collusion. So that is why there will be a culture of segregation of duties. Segregation of duties brings transparency, and it also brings accountability. Until or unless all the employees of the company are not working in a collusion or they make any fraud with the organization and all of they are partner in the crime. Otherwise, it is not easy for an organization where there are clear segregation of duties. Next one is judgment. Judgment means what? Ability to make correct decisions from many conflicting inputs. Ability to make correct decisions from many conflicting inputs. It means that wherever people are making decisions or people are they will try to collect the best possible information from the market, but it is not necessary that they have gathered the whole complete information. Now definitely you gather the information from the market which will help you to make decision, but the whole information is not necessarily the correct information. Maybe there could be any correct or incorrect variables which are available in the market as information, and you are using this information to make any decision or correct decision. So judgment is another important aspect or important part which you need to understand, that ability to make correct decisions from many conflicting inputs. So conflicting inputs, how to overcome those conflicts before making decision, it is very important from the management point of view, and it is also important towards the governance. And last very important thing is skepticism. So before moving skepticism, do you have any question regarding these aspects of the corporate governance, transparency, honesty, independence, reputation, fairness, integrity, and as well as then we discussed innovation in the financial reporting, then we discussed responsibility, then we discussed accountability and judgment, and lastly we have skepticism. What is this skepticism? Any question before skepticism? Skepticism means a questioning mind. You are working as either as internal auditor or either as external auditor or either as a non-executive director. Skepticism refers to a professional skepticism is an attitude which includes a questioning mind. You can ask the question or you will ask the question. To whom? To the management. When you are evaluating the financial statements, you will ask the question to the management. If you identify any kind of risk, you will ask the question to management. So this is called what? This is called skepticism. To provide a critical assessment of evidence, basically you are always looking for reliable audit evidences which can help you to understand that financial statements provided by the management are giving true and fair view. You are not able to or you cannot raise any concern regarding the reliability of the financial statement. So this is very important assessment of evidence. For example, non-executive directors apply skepticism in order to challenge the scrutinized management effectively. So basically, non-executive directors will make sure that there is no problem in the financial statements after asking different questions to the management or after asking different questions regarding the internal controls of the financial statements which can affect the overall uh, which can affect the overall reliability relating to the financial statement. So non-executive director wants to make sure that what financial statements we are going to publish or financial statements we are going to issue to the users of the financial statements, these financial statements are providing true and fair view. But before deciding, they will ask different questions. So this is called skepticism. So whenever you will be asked a question by the examiner from this section, from the governance section, he will ask you that use skepticism while writing your answer. Basically, skepticism is involved in professional skills. So you will be rewarded with the marks from 2 till 4 when you will follow the approach of skepticism. Any question related to key concepts of governance? Okay. Now